Guys, we have 3 stocks trading at or near their 52-week low. Now remember, the reason we look at 52-week low stocks is because they're a great place to start looking for opportunity. If a stock is down a lot, there's probably a reason for it. But the question is it down more than it should be? Stock number 1, Hershey's, HSY. Guys, this company is on my list of companies I want to own forever. This stock is at $176 a share. It was at $276.88 back in May 1st. And its 52-week low was just yesterday at $173. So this company, we all know what it does. They all sit here, and this is at a low, and I love the fact that it's sitting there. First off, $45 billion market cap, $53 billion enterprise value, $8 billion difference is essentially its debt, but it generated $1.38 billion in free cash flow last year and $1.5 billion in the last 5 years each year. Now, why does that matter? Well, we want to sit there and have companies that generate a lot of free cash flow that can pay down their debt, that can afford their debt. Hershey's has a great brand, and they're probably not going away. Imagine the world that we'd have to live in that Hershey's went away. That's what's incredible. They pay a dividend last year of 2.25%, eats up $1 billion. Their forward dividend is 3%. This is a big dividend company, but they're eating up that free cash flow. With a lot of return on invested capital, what that tells me is they don't see much room for growth. So this is going to be a slow and steady buy it at a good price. Because if they're eating up so much cash flow to pay off that dividend, I look at that saying they obviously don't see much opportunity for investment. That's okay, but it just means you got to get it a lot cheaper to get that return for yourself. Now, a couple other things I like. Very consistent. Last 5 years, profit margin of 16.12. Last year of 16.76. Sitting nice and pretty. But their earnings, net income is much higher than their free cash flow last year. But in the last 5 years, very, very similar. They're selling for 30 times free cash flow and earnings over the last 5 years. 30 is a lot, especially for a company that doesn't have a lot of growth. Coca-Cola, when Warren Buffett started buying it, he paid 30 times. Back in 1987. He still made 11.5% return on his money with dividends. Does that make this okay? Are Hershey's and Coke very similar companies and brands? I don't know. That's the question we have to ask ourselves. Let's look at the 8 pillars here. Shares outstanding jumped a lot, 23%. My guess is some sort of acquisition. So we got to take a look at that. And apart from that, they've got we already went over their 5-year PE and price to free cash flow. But let's go check out their acquisitions. So we go to their cash flow statement, go to acquisitions, and $1.22 billion right there. $480 million, $87 million, $1.73 billion right there. So really that's probably where it was, the $1.73 billion back in 2021. So let's go to their income statement. At the very bottom of the income statement, it'll show shares outstanding. Now with the global chocolate market hitting a jaw-dropping $127 billion in 2024. The average American is dropping $150 on chocolate every single year. That's a lot of action for that sweet tooth, guys. So when it comes to the US, Hershey is straight up dominating the scene. They're not just the number 1 player in the candy game, they're also number 2 snack brand in the entire country. But wait a second. Globally, chocolate consumption isn't slowing down anytime soon. The world inhales a staggering 7.5 million tons of chocolate every single year. Now, of course, nothing's all sunshine and chocolate bars for Hershey. The whole chocolate industry is feeling the heat. Recession worries are real. People are being more health conscious / weight loss meds like Ozempic that may be stealing the spotlight from chocolate. Oh, and also, did I mention cocoa prices? They've been in a roller coaster ride, hitting all-time highs earlier in 2024, only to drop by more than 40% since. That's a big drop. Now, despite all that, Hershey's is still rolling with the punches. Sure, their earnings and revenue are down, but here's the kicker. They're investing big to keep things running smoothly. They've slashed some of their stock buyback plans to make room for a whopping $600 million investment to upgrade their ERP, the Enterprise Resource Planning System. So you might be wondering, what the hell is that? Well, basically, this high-tech software will help Hershey manage its cash and resources like a pro, making sure they stay on top of their game in this ever-changing market. So of course, Hershey's is going through some challenges. A lot of people are, but I don't think they're out for the count. So let's see what the analysts think about them. So their earnings per share, according to analysts, $9.60 to $11.80. Not much growth there, guys. Not a lot of growth. And if that's true, All the more reason you need to buy it for an inexpensive price. But look at this revenue growth. 1%, 3%, 3%, 7%, 3.5%. Okay, about inflation, which I probably would expect. Probably a little bit better than worldwide nominal GDP growth. That's what I look at when I think with Hershey's. So remember, guys, this is a great story. This is a great company with a very addicting product. The question is, what's the right price to pay? It can be the most amazing company in the world, but if you overpay for it, you end up in a bad situation. I don't care how great the story is. If you pay 10 trillion for it, you're going to end up not doing well. That's why the stock analyzer was created. We created the stock analyzer tool specifically to be able to put in your assumptions about the future, both all low, middle, and high assumption, to get some sort of price that's right for you today. We start with revenue growth. I did 2, 3.5, and 5% revenue growth. Nothing huge. In fact, I could argue 2, 3, and 4, whatever it is, but I wanted to go a little bit higher on the high side. Profit margin. Good news is we see profit margins increasing from 14% on average for the last 10 years all the way to 16.76 in the last year. So I did 13.5, 15, and 16.5. Probably a little low in this middle range. I could understand somebody saying, no, Paul, that's wrong. In fact, I'm going to change that myself. I'm going to go with 14, 16, and 18%. Now for free cash flow, it's about the same. It's actually higher in the last 10 years and about the same in the last 5 years. This might just be a fluke. So I'm going to keep it the exact same. PE. Now guys, 17, 20, and 23. That's probably too low. I'm actually going to put it a little bit higher. I'm going to go 20, 23, and 26. Guys, this is a wonderful product. They do very well. If I asked you to name the number one chocolate brands in the world, you'd probably mention Hershey, and a lot of people would. So that deserves a premium with such a high return on invested capital of 21%. These are the things you have to factor in, and this is what makes investing hard. This is a subjective part of investing, but you've got to pay better, higher premiums for top quality brands and moats. Hershey's is part of that. And finally, I put my 9% desired return in. Guys, this is basically to find out what is my intrinsic value? What do I think the company is worth itself today? So I basically put the market return of 9 or 10% in there. But remember, you should probably put a higher desired return in there. That will increase your margin of safety. And you need margin of safety because we don't know the future and we're humans and make mistakes. If you're going to sit there and just get the market return, buy a low-cost ETF. But I want to do this to get a market price for the company. Hit the analyze button. Guys, I got a low price of 100, high price of 195, middle price of 140. All right. So, and by the way, these returns down here include the dividends. So I look at it saying, I just got to be a little bit more patient. And I have it on my watch list at 150, not to buy it there, but to start selling puts at lower prices. Stock number 2, Celsius. Guys, this is one of the most common stocks I see talked about in the community, on Twitter, everything. This company has come on the scene, but look at this, all-time high of $100 just back in March 14th. We're seeing a lot of companies with all-time highs on March 14th. 52-week low just 2 days ago of $27.78. That is a 73% drop in stock prices. I don't want to hear it when people say, I don't think a stock's going to fall that much. It can happen, and it can happen very quickly. It happens all the time. This is a $7 billion company with an amazing balance sheet. How do I know that? Enterprise value, $6.5 billion. It means they essentially have a negative $500 million of debt, which is basically a positive $500 million of cash on their books. This paltry dividend yield. Now, here's the interesting part about this company. 5-year free cash flow of $60 million, 1 year of $170 million. You know what that means? Growth. So for me, guys, I'm going to immediately tell you, don't focus on this 5-year number. This is useless. The 5-year free cash flow is useless because they're growing so much. Let's go look at this free cash flow in here. This free cash flow by year, lost 11 million, about $1 million, 2.8, lost 100 million, made 100 million, 123, and in the last 12 months, $170 million. I mean, it was negative in the first 5 years of this 10-year chart. So guys, here's the 8 pillars on Celsius. 4x, 4 checks. 1.25 billion increase in revenue led to 200 million in profit and 165 million in free cash flow. Now remember, I'm ignoring the 5-year numbers because of how much they've grown. It's so skewed that way. You can't possibly hold them accountable for this. Shares outstanding, 4% increase. Not terrible. I prefer to see nothing, but it's a fast-growing business. I don't blame them for issuing shares that were maybe expensive and a low ROIC, which doesn't bother me so much because you look at the 1 year and you have 15%. Okay? Because remember, the 5-year numbers, this 5-year ROIC is based on 5-year free cash flow. It's insanely low, so I'm not worried about that at all. Now, because Celsius is now the 3rd biggest player in the U.S. energy drink game. Now, the world, as we've seen, is getting healthier. In fact, I think this year was the first year that the U.S. had a decrease in the amount of obesity. Celsius is right there leading that charge with the zero sugar. As of Q3 2024, this brand is absolutely crushing it, making up 16%. That's 1 in 6 of all energy drink sales growth globally. Now, Red Bull and Monster, they're still top dogs, no doubt about that. And Monster's been one of the best companies in the world when it comes to stock price. But since 2022, Celsius has been blowing past both of them in terms of volume growth. You could say that Celsius is the underdog that suddenly got everyone talking. And they're not stopping anytime soon. 2024 has been huge, adding 6 new countries to their distribution list. Celsius is officially global, guys. But here's the kicker. Despite this insane growth and killer numbers, their stock has taken that dive, down 73% from its high of $99. If you're thinking long-term, the question is this just a temporary crash in the roller coaster ride of this brand's future? Remember, this is a company that's down 70%, but let's look at their quarterly revenue. 265 versus 384. Oops, that's not good. 401 versus 325. Maybe the fundamentals are getting worse. This is a big drop in revenue from third quarter 2023 to third quarter 2024. Remember, our goal here is to buy companies that fundamentals are getting better as the stock price falls. But here we see a big drop in revenue. So guys, the question is, why did this happen? Well, they came out and said that Pepsi overstocked their inventory. That could be the case. That very well could be the case. But is it an overstocking because they just bought too much? Or is it overstocking because demand really faltered? So for me, yes, the stock is down a lot. The question is, are they going to rebound here back to new highs? Because look, in June of 2024, 402 versus 325. That's a huge increase. That's a 25% increase, actually 20% to 25% increase in revenue. To suddenly have a big drop the next quarter, maybe. Remember, guys, these drinks are very fickle on people who love them. And you see them all over the place. It's a very easy business to get into. It's not exactly hard for that one. So you want to be careful. And also, the next time you see companies like this flying high, remember how quick it can change. They have announced that the sales to Pepsi is down almost $120 million year over year. Again, they claim it's an overstocking thing. That tells me they're claiming it is temporary. It'll be really important to see if that's the case, to decide if they're an honorable company that's going to be honest with their investors. That's very important. So, what are analyst estimates on this company? Well, analysts are enthused. $1 per share here, going to $2.74 here in the next 4 years. Big time growth, 170%. Revenue growth, 20%, 18%, 19%, 35%, 8.5%. They have revenue over about doubling in the next 4 years. So analysts are still pretty positive about this. So it'll be really interesting to see what happens with that Pepsi overstocking issue. Now, obviously, back to Stock Analyzer to figure out what's the right price to pay. Because now we have to sit there and figure out, okay, I'm going to make these assumptions based on them being honest about their Pepsi temporary issue. I'm going to make that assumption there, okay? So I did 4, 8, and 12% revenue growth, considerably lower than their history. All right, profit margin, I did 15, 20, and 25%. I started at 15, went to 20, might be a little high, guys. Might be a little high because they've not really done 20%, but they have increasing the profit margins. So actually, you know what? I'm going to be a little more conservative here, guys. I'm going to go with 12, 15, and 18%. Same with free cash flow. PE, oh, I remember why I did this. And the last time I did this stock analysis, I was trying to be overly enthused. It was back in April. The stock was flying high. So I think that was the reason why I was sitting there saying, like, listen, be careful here. Because there's a lot of, even though I'm overly optimistic, it still looks a little risky. So for PE, I'll do 15, 17, and 19. And then for my desired annual return, 9% across the board. Guys, you got to put your margin of safety in here. It's a very easy business to get into. A lot of competitors and a lot of fickle consumers out there who will change brands very quickly. Now, before I get into the numbers of that, you may have noticed, I'm sure you look at the stock analyzer tool, look at our community and think to yourself, geez, that would really help me a lot in analysis, and it absolutely does. But if you go to our everythingmoney.com website, you'll see that we have a waiting list there. And the reason being is today's software includes everything we have to offer for stocks, retirement, and real estate. Everything up here and more, right? But we're making changes behind the scenes. So this offer is going to go away very soon. If you were with us from the very beginning, I built this software for myself, and it was an Excel sheet. And people would ask in the comments, how do I get that Excel sheet? We finally decided to be somewhat smart and give the people what they wanted. So we made the software. Remember, I was using it for myself before. This software has helped me make my investment decisions for stocks and for real estate, where I bought $30 million in real estate in the last 6 months just based on using this software. In addition, I get many ideas from our community members on different stocks to buy. But as we've grown, it's become less about me and more about how I can better serve you and our community members. And this is why we update our software constantly to give you exactly what you need to get better. The good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life. And guys, this is probably the best deal we've ever offered. I'm telling you this now because there's still time for you to sign up. As long as you join our EM community before we make these changes, you can keep your plan as is with all these tools, even after the changes are made. So click on the link in the description below to get access to everything we have to offer, including all of our investment tools and the community. And I'm willing to bet it'll be the best decision you've made all year. So let's hit the analyze button here. The stock's currently at $30 a share. So I see a low price of 12, high price of 37, middle price of 21. Guys, the stock is down 73%. It's a lot, and it's wonderful. For me, it's not such an obvious screaming deal where I have to sit there and go, I got to jump on this. Yes, a 73% drop is awesome, but it just goes to show you how overpriced it was at 100. Stock number 3, a highly volatile stock, Super Microcomputer. This thing has been all over the board. Guys, look at this. All-time high. Very close to our March 14th date. March 8th, 2024 of $123. The low was 2 days ago of $20. Guys, that is an 86% drop in 250 days. And this is a stock that I'm sure that if I was covering it back then, people would have said, look how stupid you are, Paul, you don't get it. Maybe so. But what's happened lately? Ernst Young, one of the biggest accounting firms in the world, one of the most reputable, said, we're out. We're going to stop auditing these guys because these guys are unethical. All right, so what's the deal with the company? Is it possible they clean things up? Yeah, but the question is, who are the people who are going to clean it up? Guys, this Super Microcomputer story is a wild ride. The company's absolutely been crushing it, in quotes, over the past decade. You know, back in 2014, they were bringing in about $1.5 billion in revenue. Fast forward to today, and they're bringing in $11.8 billion in revenue. Earnings went from $54 million in 2014 to over $1 billion in the last 12 months. A 20x growth in the last 10 years on their profit. And get this, Supermicro stock went from just $1.70 a share on January 1st, 2014 to that peak of $1.23 back in March of 2024. But it gets even crazier. In the Q4 of 2024, the company posted a jaw-dropping 143% revenue growth year over year. For the full year, they've already seen a 110% revenue boost. That's some serious rocket fuel, guys, for their business. They're powering everything from cloud infrastructure to data centers, and they are absolutely riding this massive wave of AI growth. But remember, this is exactly what happens. Whenever there's some big market, all the ancillary people around it will surge with it. They've been in the right place at the right time. So what's that problem? It started with those auditors at Ernst Young. They bailed on them due to some serious disagreements over how Supermicro was handling their books. Then back in August, Hindenburg Research, the big short-selling research company, dropped a bombshell with a report accusing the company of accounting fraud. And Hindenburg is not a company that comes out there and just says it just to be dicks. They say it because they do a lot of research. And here's where things get even more messy. This is not Supermicro's first time getting in hot water. Back in 2018, they were nearly kicked off the NASDAQ for failing to file financial statements. Guys, why is that? Why would a company fail to file financial statements? Their CFO should be in there. Guys, I have 8 businesses upstairs. I have 30 bank accounts for these businesses. And guess what? We reconcile every single day. Yes, it's not the same as a multi-billion-dollar company. And a lot of people, like my accountants, think I'm crazy for reconciling every single day. But the reason is, the second our quarter is not done, I want 6 or 7 days and our numbers are done. Yes, it's different for a big company, but to fail to file financial statements, go look at when was the last time that happened with other major companies. Then in 2020, guys, the SEC came knocking after it was discovered that Supermicro had artificially inflated their earnings by about $200 million. Let's put that in perspective. In 2020, they did $3.34 billion, $200 million extra in earnings. Look what they ended up reporting, $84 million. That was the adjusted number. So they'd reported over $200 million extra. The company settled for $20 million, but here's the kicker. 3 months later, they went and rehired the same executives who've been at the heart of the fraud. That's a bad look. That's where I get concerned. A company can change, but you got to change with new people. So while Supermicro's future appears to be bright with AI booming and their tech in high demand, the shadow of past mistakes and the current accounting drama means this roller coaster is probably far from over. You need to stay tuned on this one. Now, are you the kind of person who sits there and says, no risk or reward? I don't know. But until they completely make over their entire executive team, even people who probably are innocent to this, you got to start from scratch to show Wall Street you're really serious about change. So I wonder what these analyst estimates are, if they've been updated. Guys, Supermicro still have this EPS issue. So guys, right now is where I'd sit there and go, let's put it in Stock Analyzer. But we have verifiable reason not to trust the numbers. So I think for myself, I'm just a pass on this one. And I'm okay if the stock ends up going to 500 because they figure out their accounting issues. I'd rather wait for the right companies that I trust. So guys, if you want to watch the next video on top undervalued stocks, please wait for it. Thank you for your time.